Hello, my name is Martin Clayton and I'm an advisor at Swan Financial Consultancy. The modern approach to asset allocation relies on statistical modelling developed over the second half of the 20th century. In particular, it relies heavily on the way various asset classes have performed during different economic conditions to attempt to predict the future. It appears to provide a single right answer for any investor's investment objectives. Crucially, it's based almost entirely on past performance. It also assumes that the future will repeat what has happened in the past and, more dangerously, that what has not happened in the past cannot happen in the future. However, events during the last decade have seriously undermined this approach, just as unexpected events have done in the decades before. Conditions that the models predicted would only happen every 200 years or so seem to happen all too often. The truth is that in both the short and not so short term, markets are at the mercy of any number of factors that are unknown and unforeseeable. Whatever the state of the economy, an event such as 9/11, or the collapse of Lehman Brothers, or the Chinese government suddenly deciding to put restraints on bank lending, or a decision by Saudi Arabia to reduce its oil exports, can all have huge effects on markets almost immediately. So the St. James's Place approach to investment management doesn't rely on the statistical computer models, but takes a common sense approach backed up by expertise and experience. In deciding on the right approach to investment, we have always advocated that investors should follow a series of simple but robust principles. We call these the 5 key rules for personal investment, and they've all been developed from the impossibility of predicting what's going to happen in the short term. Rule 1. Invest for the longer term. As the short term is so unpredictable, you should always plan your investments for the longer term. Planning investments in the expectation that they're going to do well over a 1, 2, or even 3-year horizon may lead to disappointment. Equally, to ensure that you're able to hold on to your investments if value falls, make sure you have enough liquid cash to meet any short-term emergency. For example, when the dot-com bubble burst in 2000, UK share prices, as measured by the FTSE All-Share Index, fell sharply. In 2001, share prices fell by 13%. It was 22% in 2002 and a further 15% just by the first months of 2003 to March. Over the next 4 years, UK share prices rose and exceeded the levels achieved in 2000. However, any short-term investment objectives based on investments in UK shares wouldn't have been achieved. Regularly, the press and the media indicate shares have gone up too much in value or have fallen too far. They tell you to sell shares if they indicate they're overvalued, or buy them if they're undervalued. They discuss with what seems to be certainty what is going to happen to shares over the next 12 months. But in reality, as past events have consistently shown, when it comes to predicting what will happen to share prices in the short term, no one really knows. All you can say with a pretty high degree of confidence is that if you hold on to those shares for the next 10, 15, 20 years, you're likely to be better off than you are today. Which leads us into rule 2. Keep adequate liquidity. You always need to have access to funds in case of emergency. You should never have to sell long-term investments at a bad time, such as a sudden fall in market values. And coronavirus has been a perfect example of that in 2020. Why would you want to take your money out in April of 2020 when it was worth 20% more in January? How much should you keep liquid? 1 year's income? 2 years' income? There's no set rule. It really depends on each person's individual circumstance and also their attitude to risk. As a guide, keep enough to enable you to sleep easily at night, enough money to meet your expected needs, and enough for emergency or unforeseen funds, and then a little more to feel real safe. Rule 3. Never ignore the risk that at some time in your life you are going to have to live through a period of significant inflation. The effects of inflation can be just as severe a risk as a sharp fall in the markets. However, market falls are almost always followed by recoveries, whereas inflation permanently reduces the value of your savings. In real terms, by doing nothing with your money, there is a significant risk to its value. The impact of inflation can be seen here. So, whilst you should maintain money on deposit to meet shorter-term needs, there's a significant risk in trying to play safe by putting all your money into cash-like investments. When deciding to invest, you should always include the risk of inflation amongst the uncertainties. We've never seen that more than in ISAs at the moment. Rule 4. Diversify. Diversify your investments as widely as you can. Once you've decided what level of cash you feel is adequate, use investments which have the potential to grow in value to protect you against that inflation. However, so that your assets won't all react in the same way to financial or economic impacts, diversify your investments as widely as possible. Whilst they may not all be going up at the same time, ideally they should not be going down at the same time. There are different ways to diversify, and the more you can use, the better. You could diversify by investment, shares, bonds, commercial property, 3 asset types that provide potential for growth. But then within those types of assets, diversify further. Rather than investing in shares in 6 or 7 companies, invest in funds which spread your money widely across many more. You could even ensure further diversification by choosing funds which invest across different sectors of the economy, and also by spreading into international investments. Rule 5. Find the very best managers you can for your investments. When you're looking to diversify your investments, there are a huge number of investment managers across many countries. As is always the case, some of them are better at investment management than others. And even more important, some of them are much worse. In order to achieve your investment goals, it's critically important to try as hard as you can to have your money with good managers and avoid the bad ones. So, given the unreliability of statistical models to accurately predict the future and the range of asset classes and managers available, how do you determine the mix of investment and managers that's right for you? It really begins by understanding your investment objectives and your attitude to risk. Are you looking to save for a defined period of time, or are you seeking a specific capital sum or income level, for example, pension, retirement planning? Are you simply investing a lump sum with the intention of generating capital growth, or as part of an overall tax planning strategy? How comfortable do you feel with the short-term volatility that you may experience in the equity markets, which is simply the price to pay for the chance of generating superior returns? And finally, what impact will inflation have on your investment strategy? Having identified your goals and defined your attitude to risk in a world of uncertainty, the next step is to create the right mix of investments, or a portfolio, in other words, to give you the best chance of meeting your goals. Within this, there'll be a discussion about the right tax structure to use. For example, investment bonds, unit trust, pensions, ISA. And remember, once you've picked that mix, it's important to review it regularly. What was right in one year may have changed a year later. Circumstances change, and your portfolio should too. Revisit those 5 rules whenever a circumstance changes in your life, whether it be marriage, death, children. It's really important to keep reviewing. So, how does that link into what we do and how we choose to use those rules? The St James's Place investment management approach utilises all 5 of those rules to create a set mix of portfolios, fund managers picked for you. So, logic dictates, if you need a fund manager that's specialising in North American stocks, perhaps we should look in North America. If we need someone in Oceania, let's go there. We travel the world and we make sure that we've got the best fund managers in the best locations managing your assets. And that can be seen on the map. And to make sure we're doing the right thing, we've got independent advice as well from Stanford Associates and Reddington, and it's really worth having a look at what they do on their websites as well. And as you can see, the Investment Management Committee don't rest on their laurels. Hopefully that emphasises one key point to you. It doesn't matter whether you're starting up your first ever stocks and shares ISA or whether you've got a really complex inheritance tax problem to solve. These 5 rules are important and personal
just as with
to
Stanford
everybody.
Associates and Reddington,
Make sure that you study those 5
independence is
rules.
key.
Make sure that you're
Our
not
investment
putting yourself in a
management
dangerous
committee has
position in the
4
short
independent
term
members
to try and
sitting
benefit in the long
alongside
term.
the St.
You
James's
won't
Place
benefit
members.
if you have to draw out. Advice is very much a personal thing. Have a look at it. Ask us questions. We're here to help.